It appears the banking turmoil is not as ring-fenced as we'd hoped. After JP Morgan took over First Republic last Monday to save it from failure, several other regional banks started to quake. Metropolitan Bank and First Horizon were down 50%, Western Alliance down 60%, and PacWest shares fell as low as 70%, and the company said it was exploring a sale. They've all recovered slightly, and who knows what will happen by the time we air this. But my question to you, Scott, is what could we have done to prevent this? And what can we do now?
Well, and again, we don't know what's going to happen between now and when we air this program, but those stocks you're talking about have recovered somewhat. They're up between 4 and 8% today. And my guess is it's on reports that you aren't seeing the same level of outflows that you saw at Signature or Silicon Valley Bank or First Republic. It all comes down to the same thing, and that is if something's got to happen with FDIC insurance. And that is either the cap needs to be removed or dramatically increased. Because if you have a smartphone and you have over 250...
And sorry, can you just explain the cap for us?
Sure. The FDIC is a governmental supported agency, I think, but technically not a government agency. It charges a percentage of deposits to banks. If a bank has $100 billion, it says, okay, give us 28 million or 100, I don't know what they charge, a certain amount per year. And if your bank fails, we will make good on anyone with less than $250,000 in deposits. So you can say we are FDIC insured, and very few people will invest in a bank or make deposits in a bank that is not FDIC insured. So it's a good housekeeping stamp of approval that basically insures your deposits and gives people confidence that they can make these deposits, not lose their life savings. They don't have to do much more diligence than see the terms, those 4 letters, FDIC.
Yeah.
Now, what happens in an information age economy when you hear about bank failures and you have a phone and you can transfer assets seamlessly? Why would you not transfer your assets to a bank that is effectively FDIC insured to the moon? And that's JP Morgan. Because if JP Morgan has a bank run, the FDIC is Janet Yellen and Chairman Powell, who will just say to the bank, okay, the window is open. You can borrow as much money as you need from us to make sure that everybody gets their money out, that anybody who tries to withdraw their money from JP Morgan, it's no problem. It's no problem. So effectively, what you have is a series of banks that have unlimited insurance that are backed by the full faith and credit of the U.S. government, the banks that have become too big to fail. And then you have regional banks, which are only going to be able to attract deposits of $250,000 or less. And the regional banks play an important role. They have niche products. They cater to a certain type. You can bet there's regional banks in Texas that are very good at addressing the specific needs of oil and gas companies. Mm-hmm. You can bet there are companies in Michigan or banks that will write factor loans for companies that sell auto parts into the big 3. I mean, they're just going to be there's a great ecosystem of banks. Now, there might be an argument that these smaller banks shouldn't be in existence, that the banking sector is too fragmented, that we need a smaller number of stronger banks. You could make that argument, but be clear, you're just going to see a massive outflow from the kind of the outside, I call it the top 8 or 10 banks, or a massive inflow into the top 8 or 10 banks by deposits from everyone else. Because those companies, by virtue of being that big, effectively have FDIC insurance with no cap. Mm-hmm. So the big discussion that's likely taking place behind closed doors in Washington, D.C. is what are we going to do with FDIC insurance? Should we remove the cap? Should we dramatically increase it? Otherwise, what we're effectively saying is we want a much smaller banking sector. And the downside of that, or one of the downsides of that, is that when you go to buy your first house, there's going to be fewer people bidding on that mortgage, and fees are going to go up slowly but surely across every product that banks offer. So essentially the regulators have a decision to make, and that is how much. The issue they have to wrestle with is the following. And that is the tension between having a more robust, diverse banking sector that is more competitive and offers people more specific differentiated service at lower fees, which is the wonderful thing about a highly competitive market, versus the risk of having a bunch of banks that might be subject to some sort of run because they're seen as more vulnerable. And that might be, so I think they're either going to decide, yeah, we need a consolidation of the banking sector and won't do anything, or they're going to decide, no, we need regional banks and we're going to massively increase or remove the cap. What are your thoughts?
Well, I think that you're bringing up an interesting point about risk here, because it feels like this is all a giant question of who's going to assume the risk. And, you mentioned the idea of we could take off the cap and, it'll be backed by by the credit of the US government. But in that case, to me, that is just a transfer of risk into another entity, in this case, the US government. And as we've seen, the criticism lately around our economy has been that the US government's response to things is, one, to pay for things with taxpayer money. That's been a criticism about this situation. There's some nuance there that we can get into. But the other issue is that the US government's response to problems is, let's print money and we'll just throw money at the problem. And don't worry if you take on too much risk as a bank, because we've got you. And how do we have you? We're going to print money to solve the issue, which of course is the driver of inflation. That is the reason that inflation has gone up 7, 8, 9%, and eats into the savings and the spending power of regular Americans. So to me, the question is becoming an interesting question of how do we tailor the cumulative amount of risk in the system, and how do we spread it out evenly in a way that's fair to everyone, and probably in a way that doesn't hurt the smaller guys as much as possible. And this is playing out in an interesting way because, these smaller banks are getting crushed. The JP Morgans of the world are killing it now. I mean, JP Morgan's going to assume $2.5 billion in profit from this deal. But it feels like that maybe there wasn't a choice, because we also had to protect the people whose deposits were in those small banks. So I guess my question to you is, how do you think about this idea of where we place the risk in the system? And I know there's no answer here, but what is the best way to do that?
The honest answer is I don't know. The Democrats will talk about the importance of having niche local banks. Everybody loves the small business person. I would bet there's a bunch of Congress people who were formerly the founder or the president of some local bank. And when you think about it, so what is it? The top 15 banks control 75% of deposits in the U.S. And just saying that, you think, well, it's a concentrated industry. We need more competition. What industry that's this size has that lack of concentration? There's one search engine that controls 93%. One social media company owns 2/3. If you took the top 15 automobile companies in the United States, they control a lot more than 75%. I bet there's 10 that control 80%. So this is not, I don't think you can make the argument that this industry is too concentrated. And these runs or these risks or these runs present real systemic risk. So the question is, one, should the banking business be more regulated? And I would argue that's a mistake. I think it's just a miracle if you think about this, all right? If I said, okay, I'm going to give everybody $120 to go invest in their own startups. And then they said, okay, what do you need for that? I'm like, well, I just need to get $100 from a variety of investors. And I'm like, well, how do you do that? How do you turn $100 into $120 of investor capital? It's like easy, as long as my depositor base is diverse, they're not going to ask for it at the same time. And even if the economy or my investments only grow 5%, I can grow the economy at 6% instead of 5% because I got additional leverage. That is the miracle of a modern banking system. So I think you want to encourage a certain level of promiscuous, risk-aggressive behavior. When Elizabeth Warren or Senator Warren says banking should be a boring business, it should be one-to-one, deposits equals loans, that's a bad idea. You're going to have slow growth. Nothing sucks more than an economy that isn't growing. So I think that a certain something that encourages risk aggressiveness or a certain level of risk aggressiveness makes sense. My solution would be to dramatically increase the level of FDIC, the cap. Because what you might want to say is, all right, say you took the cap to $5 million. What would that mean? Probably 96 to 98% of all your depositors wouldn't feel the indigestion that you wake up with one morning or the fear that causes a run on the bank. Then the question becomes, well, do you create moral hazard because people don't do diligence on the bank that they're depositing money into? And I don't think they were before. I don't know. The question is, do you lose a certain amount of scrutiny? Do you create moral hazard? Do you potentially set the FDIC up for massive bailouts? But they've been covering all the deposits anyways. So I like a diverse banking sector. I do think these niche banks, and I'm biased because I got great service from SVB. I thought they were great at what they did, and my understanding is up until the very end, they made good money and were a good company. So I wonder if you just don't solve this by massively increasing the cap. And what does that mean in terms of expense to the bank? Because right now there is no cap. They're paying out anyone. They're paying out at all. So I don't understand. I think I would want to battle test. Well, let's raise the limit. Let's not remove the cap, but let's raise it dramatically such that the majority of depositors just aren't worried. Just don't. You lose. If the cap had been 5 million, the majority of VC-backed companies probably would have said, we're fine. We don't need to pull our funds. We don't have more than 5 million deposited here. You'd lose some big guys, but maybe the big guys should be at JP Morgan. Anyways, that's my sophomoric thoughts so far.
Yeah. I know we're going on long. I just want one more point, which is a lot of people are saying that the taxpayers are paying for this deal because this is going to cost the FDIC $13 billion. The reality is that the taxpayers aren't actually paying for this. It's all funded by those fees that the FDIC takes from the bank so that it has this emergency fund. But the more reasonable argument that people are making, specifically that actually conservatives and Republicans are making, because Biden said taxpayers aren't paying for this, and then the conservatives want to bash that. And the reasonable argument is that taxpayers are indirectly going to foot the bill. And basically the idea... Sorry?
Depositors are paying for it. When you deposit...
But they make that, the depositor and the tax... Exactly, it is depositor, but they're saying the word taxpayer to indicate the average American, because everyone has to bank with a bank. And the idea is that what will happen here is that this will increase rates on the rate you'd have to pay on a loan, because the banks are going to have to make good on the difference that they lost because of this. I don't really buy it. I don't think it's that. What do you think of that argument?
The people that are paying for this are depositors. And that is, if you put $100 into a bank, a certain amount of it, probably, 10, 20, 40 cents a year goes to the FDIC such that your deposits are insured. And if we have a weak banking system and they keep going out of business and keep having runs, then the cost to you is going to go up because the FDIC is going to have to charge richer and richer premiums. So there is some truth to the notion that premiums that depositors, and the majority of taxpayers probably deposit money at a bank, are going to have to pay higher and higher fees if we have a banking system where big banks consistently go out of business and the FDIC has to show up. The same way that your insurance premium goes up in Florida when there's a lot of hurricanes and a lot of claims. The more claims, the higher the insurance premium. The question is, what is the balance, right, between what is the lesser of the two evils? An increase in FDIC premiums that ultimately get passed through to depositors, or the additional fees every depositor is going to have to pay, or every bank customer is going to have to pay with a less robust, less competitive banking system. That's the fulcrum. That's the tension between the two that smarter people than me need to decide. And by the way, just some data on concentration of industries. If we look at the airline industry, Americans at 19.5, Southwest 17.4, Delta at 16.3, United at 12.9, Alaska at 5.4, U.S. grocers, Walmart's at 18, Kroger at 9, Costco at 6.4, Albertsons at 4.7. So you're talking about these industries. The banking industry doesn't look more concentrated than some of these other big things. The difference is that the banking system Kroger's probably isn't going to cause a run on the economy if it goes out of business. Although I would argue the food supply chain, if Walmart and Kroger's had said, we're shutting down all our stores during COVID, I think you would have had a lot of people, most likely in Florida, who would have said, honey, grab the Glock, we're headed to Publix. So that would have been scary. But nothing creates the sort of systemic risk to the economy like the banking sector in terms of vulnerability, at least that I can think of. Mm-hmm. Maybe there's something else that presents more of a risk. But this does warrant additional scrutiny and really thoughtful people. But that's, if you will, it's the tension between increased fees and greater insurance premiums from the FDIC.
So Mia pointed out something interesting, which is that fintechs seem to have figured out a workaround for this FDIC insurance cap we're talking about. So SoFi, Mercury, and Crescent, all fintech companies, they all launched deposit products this month that are insured beyond the $250,000 cap. In other words, you can deposit $2 million with SoFi, and they'll guarantee that all of that money is protected by the FDIC's backstop. Now, the way they do that is by splitting your deposits into individual $250,000 sums, and then they spread those deposits across hundreds of FDIC-insured banks. Now, we wanted to find out how viable this idea actually is. So we spoke with Professor Sabrina Howell, professor of finance at the Stern School of Business. One of her focus areas is fintech. And as it turns out, she thinks emergent fintech companies could potentially fill the void left by regional banks if they continue to fall.
I actually think they're one reason why I'm less worried about consolidation in the banking sector, because these new fintechs are offering consumers like new options, high quality service at lower prices. Mercury, for example, is now the go-to bank for new startups. If you set up a business, there's no button at Wells Fargo or JP Morgan Chase to open a business account when you have zero revenue and zero operating history. It used to be Silicon Valley Bank was sort of the only game in town, but increasingly it's Mercury and a number of other new players. And they are looking to provide all of these, interesting new services, including spreading cash around to insured accounts. And I think there is this sort of growing role in providing new competition, not just in banking, but think about startups like a Blue Vine providing small business loans, partnering with a charter bank that actually does the origination as sort of like it's almost like a utility company, bank as utility company. Or you have big tech companies like Apple or Amazon providing consumers payments and banking services. And so I think there's actually a lot of really good reasons to encourage entry by these new players that are offering online financial services, and that they can become, the next iteration of what was the sort of smaller players, the regional banks, the smaller banks in the financial ecosystem.